Tyler, the market is back to those high levels, but not all stocks are at all-time highs. There's still a lot of stocks that are way down and a few that you and I both think are really attractive buys right now. You ready to talk about some of our favorite stocks that look like they are bargains today?
One of the best things about looking at stocks all the time is at any given point in any market, somewhere, there's a pocket of value. You just have to go find it.
And we are going to talk about one of that little pockets of value right here on Investing Unscripted. I'm Jason Hall. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, check out our special link. It's fool.com/unscripted. The Motley Fool's got some great stock ideas for you for free. Be sure to check that link out. Okay, Tyler, let's talk about three stocks in particular that are still way down. Rexford Industrial Realty, EPR Properties, Realty Income, all of these stocks going back to the beginning of 2020 because they're all off of their all-time highs from various points along the way. All of them are down between 31 and 39% from their all-time highs. Tyler, they have some things in common. The obvious thing they have in common is that these are all real estate businesses, right?
Yes, they're all real estate investment trusts specifically. I wouldn't call all of these companies household names. I guess it's one of those things where people that are stock junkies have probably heard of Realty Income at least once or twice. They're one of the largest REITs in the world. EPR, I don't know if they've heard it, but they may have visited one of their properties.
If you're in North America, you almost certainly have been in an EPR owned property.
And Rexford, well, I mean, I think of the two people here, I think we know which person picked that one.
Yeah. And it's not me. But here's the thing about it. You may not know about it, but there's a very good chance that you may have a product in your home that product or something in that product went through one of Rexford's facilities at some point. They are really critically important industrial real estate in the distribution supply chain end of things, which that's become a household name. Supply chain. I'll kick things off and I want to talk first about maybe the one of this group that I think is probably, it's best to say that maybe still has the most business risk, and that's EPR Properties. Of this group, EPR, I'm looking off the screen right now just to verify, but it's down about 39% from its high. It's down the most. And that its all-time high was before the pandemic. This was back in 2019, I believe, was when it hit its all-time high. But really, Tyler, it makes sense that its stock is down the most. Why is its stock still down the most?
Well, they're an entertainment property specialist that is pretty diverse. Amusement parks, ski resorts, a couple other things in there. But the real big one, and the one that's really hit the hardest, has been theaters, specific movie theaters. And
right, you see it right on the screen. It's 39% of their rents. It is a substantial amount of the business. And unless you've been living under a rock for the past 5 years, the theater industry, particularly in North America, is absolutely in a state of decline.
Dude, I lived in sub-Saharan Africa for 6 years, and I knew the U.S. movie theater industry was in decline. So you have to be pretty deep under that rock.
That's fair. There is still some risk and some overhang from that movie theater business. Again, you see right here on the screen, it's 39% of its rents and 93% of its rents are from experiential businesses. But the thing that's appealing is that these are largely internet and e-commerce resistant sorts of things. Eat and play, we've seen an explosion in growth of interest in the restaurant gaming experience. Mentioned amusement parks, so their attractions business is big. Ski resorts is big. Gyms, fitness is an interesting thing. Lodging, travel and entertainment is bouncing back around the world. Gaming, so casinos. These are things that people, if there's one thing we've learned, Tyler, from the pandemic, is that people do want to get out and do things and experience things in the real world. I want to share one thing. Yes, 39% of the business is large, but then the number is coming down. The company is making substantial progress on reducing its exposure to movie theaters. We saw last year, middle of the year, it had a resolution with Regal that was going through bankruptcy, and its cash flows were largely unaffected, sold theater chains to Santikos. And when that happened, they paid off the entire rent balance that was deferred. Their balance sheet is in perfectly fine shape. And put it all together, and as much as that industry is in decline, it doesn't really seem like it creates an existential risk for EPR. And I think if you're living more on the risk reward opportunity side, I think EPR is really attractive right now. I think the dividend is largely secured, but it's not as rock solid as some of these others that we'll talk about. Tyler, you want to talk about Rexford?
They are an industrial real estate company, which means light manufacturing, warehouses, distribution, kind of all the things that make supply chains in the world go round. They are hyper-focused. All of the properties they own are either in Los Angeles County, Orange County, San Diego County, and even some San Bernardino County, and basically all of the larger Los Angeles, San Diego metroplex. Now that sounds like a hyper concentrated industry, right? Well, that industrial real estate area is larger than the entire market of Germany. It's huge. It's a huge
Mhm.
market relative to basically anything else in the United States, specifically because of trade. The Los Angeles Long Beach port in the United States touches about 40% of every container that goes in and out of the United States. It's a massive, massive point of distribution of goods in the United States. And that's what makes industrial real estate in this area so valuable. It has to touch so much of the globe, of the United States economy in this small concentrated area where industrial property, just like what is zoned for industrial, is shrinking. And so what you get is very low vacancy, very rapid growth, like higher than international average growth for rents. And it's just it makes it for a very secure location. Just to give an example, if right now Rexford estimates if the market were to go completely sideways and they couldn't raise a dime in rent for the next 2 years, there's already 33% growth embedded in their business from legacy contracts rolling over, new development coming online, and upgrading some of its existing facilities. So we have a very strategically located business that has a lot of growth built into it today. It's still down. It's not the most like biggest dividend yield stock, but it has grown its payout considerably over the past 10 years, typically almost 20% a year. So with that, I think that this looks like an extremely attractive opportunity, one that I own, one I will probably continue on for a very long time.
Last note on REXR. This is one that is easily ignored by a lot of dividend seeking investors because you look at the yield, it's been below 2% in the past, and now it's still below 3%. But then, like Tyler said, you put the dividend growth rate on top of that, and it's maybe not the yield you're going to get today, but the yield you're going to get in 5 years or 10 years on your cost basis because they're so important where they are. The real estate's so highly valued. Demand for it is only increasing, and then their ability to yield economic results and grow the payout is really good. The last one here is realty income, and it's certainly, if you're a dividend investor and you've never heard of realty income, then you probably haven't been a dividend investor for very long. And what makes realty income really appealing is a couple of things. Number one is the type of real estate they target, and they're the best at it is really important because it, again, like we talked about with EPR, where that experiential stuff, internet and e-commerce resistant largely. So is a lot of realty income space. A good bit of it is like restaurants, standalone restaurants, like fast food restaurants, that sort of thing, but also experiential things. A big deal they did recently, they invested about $1 billion in owning the real estate that the Bellagio sits on in Las Vegas. So they're expanding into other things that are still standalone real estate. But as they put right here on this particular slide, 77% of their portfolio, the rents are non-discretionary, low price point, or service-oriented retail.
This is
Go ahead.
auto parts retailers and oil change companies and Starbucks and basically a lot of the things that are more or less kind of staples of economy that you basically probably don't even think about, but are hyper important and are going nowhere. Like when you need an auto part, you're going to go to a store and go get it. If you need oil change, you're going to go to a store and get it. You can't Amazon an oil change.
Right. The basic model is you get the dividend yield and then their growth of funds from operations over time, total operational return, you're looking at high single digits, low double digits. And over the long term, they've been a market beating stock. I want to share this, the same thing we did for Rexford. I want to share it for Realty Income. Dividend yield about 5.5%. So certainly on the higher end of what it's been in recent years. And you see these little tiny bumps here. Realty Income pays a dividend monthly and has a really long record of growing that dividend almost every month, not just every year. They've grown it every year since they went public in 94, I believe, but they grow it most months too. So for income investors that are looking for now income, it's a great way to stabilize your own cash flows, grow them at a certainly much higher rate than inflation, and own a company that not only has really resistant, resilient businesses to the impacts of the economy and to e-commerce, but also this is the most powerful thing in real estate, Tyler, is they either have money or access to money when nobody else does. Recently, Digital Realty Trust partnered with them to help in a joint venture fund a data center. So when you're helping one of the leaders in data fund their growth because access to capital might be a little bit more constrained, that means that you have money when nobody else does. And I think that is a wonderful investment for anybody that's looking for dividends and they want to also be able to beat the market. I think Realty Income is the one of these three that gets my vote.